Alright, it's 9 o'clock now, and let us get ready to get started. And for those of you who are here right now, I thank you for joining us in today's session where we'll be going through my stand and what I think is going to happen as we move forward towards the earning season in the general broad US market. And also, I'll also be revealing to you some tips and tricks that I use to search for great investment deals and insights, and also trade ideas that as we progress through this market in the current situation and the market condition that we have. All right, so let us first take a look at the S&P 500. We can see that. All right, let me first get up my drawing tools. All right, so we ended last Friday on this somewhat of a bullish pin bar candle, and it is right in the middle between the 50-day simple moving average. Right, so for those of you who are not so familiar, let me refresh again. This is the 20 EMA exponential moving average. This is the 40-day exponential moving average. The blue line, solid line right here, is a 50-day simple moving average, and then the red line is the 200-day simple moving average. The green line is the 150, and the yellow line is the 100. All right, so we are looking at daily chart right here, and we ended last Friday with this bullish pin bar over here. And what are my thoughts of this? So previously, as we experience this huge correction right now, I've been saying do not sell your positions yet. If you want to sell off your position and get your profit, to protect your profits, this is not the time while we are in this decline, and wait for a rally to a strong area of resistance, such as the 20-day exponential moving average right here, to sell off your position and protect your profits. And right now, you can see that the bullish correction that we have experienced right now is stronger than what we have expected. It has corrected all the way back to the 50-day simple, 50-day, 50 SMA. All right, so if you are still bearish on the market, this is perhaps the best opportunity that you have to to short the market or apply protective puts, as we can see that we are in a very strong level of resistance at the 50 SMA. And if we go back to previous experiences, you can see that for previous market crashes, wait, all right, this is not that big of a crash. If we go on to look at the 2007 global financial crisis, right, you see that the 50-day SMA is acting as a strong resistance over here. Oops, it's lagging. All right, so the global financial crisis, you can see that a huge drop over here, and then it retrace back to the 50-day SMA, and then it dropped back down further, make a double bottom, and then have a stronger correction again. And then again, resisted by a strong moving average support, which is a 200 SMA this time, and then crash further down. To be played out like all other bear markets that we have experienced so far, then this candle right here could be the sign that the market is going to overturn and go back further down, for sure. Now, one way is to wait for a bearish candle, one black crow pattern, and then this will indeed signify that All right, is this still playing? Is it lagging out? Okay, we are back. So wait for back to what I was saying. Wait for a bearish candlestick pattern to form to have a better signal that the market is indeed going to correct back down. But in fact, for me, I'm currently right now slightly bullish, as you could have already been as you could have already known, and from reading all my Facebook posts in Growing Wealth so far, I have adopted a slightly bullish position once we started this correction up here. So why? Because there are several reasons that I've pointed out. Firstly, I've mentioned in my previous market analysis video that on the weekly time frame, the S&P 500 SPY is being oversold, and we do not see an oversold condition on the weekly time frame of the SPY frequently. We only experience this oversold condition during the major market crashes in the financial crisis and dot-com bubble crash. So this is one reason why I turned bullish at this area. And then what happened is, what do we have subsequent after our this retracement upwards? First, we have the major unemployment day here. What do we have? 3 million over unemployment numbers, and market continue going up. Next, we have another number already. We have another 6 million unemployment number day, and that could be perhaps, I think, this candle over here, or somewhere during this period. And again, on major bad news, what do we have? Market goes up. And then last Friday, if I'm not wrong, another 5 million unemployment numbers. And what did the market react? Initially, it go down quite quite deeply on a on an intraday basis. But towards the end of the day, the market still rally upwards, forming this small bullish pin bar that we see over here. So in total, we have already 14 million unemployment numbers. Now, this is definitely a very bad news. This is a very bad news and a very bad sentiment for the economy. But remember, what we are looking at right now, right here, is the market. It is not the economy. And what does the stock market do? The stock market is a leading indicator of the economy, and in fact, it is leading by at least 6 to 12 months, I would say. So when we have such strong negative sentiment in the economy and such negative news coming out day after day, and then markets still continue to rise, this somehow signals to me that perhaps the worst has been priced in already uh, in this huge crash over here. Perhaps maybe what is happening over here is that maybe they could have already priced in like what somewhere like maybe like 30 million unemployment numbers, and when they say that the news is actually not that bad, the rally keep going up higher and higher. All right, so just one point in mind: do not base your market decisions on news. Do not base them on news, as the stock market do not as when the news has already been released, it is already too late. All right, most of these news have already been priced in into the market previously. Okay, so, and as I've been posting my analysis on Facebook, what I've been getting is comments like, "Oh, wait for another week of unemployment numbers," and then another week of unemployment numbers come, it continue to rally. And after unemployment, what's the next excuse that they have for the market to crash? That is the earnings season. So in fact, during last week over here, the banks, JP Morgan and Bank of America, BAC and JPM, they have already released their earnings. So as we proceed on in towards the final weeks of April, we have more earnings coming out. So whether or not these weak earnings or bad earnings will impact that market that much, such that we experience a huge major crash back down again, is definitely an issue to be concerned with. So personally, what would I be looking out for? Previously, I said that to have a higher chance of being correct, wait for a bullish, a bearish reversal candle, like, such as a what's that, the the black crow pattern, right? So in fact, for me, because I'm slightly more bullish, I'll be willing to wait for a stronger correction back down before I adopt a bearish stand again. So as you can see here, this uptrending trend line that I've drawn, this this line could have been drawn when the market made a higher low over here. So the lowest low at 220 over here, and then another lower low at 245. So with these 2 points, we can connect them together, and this gives us this pretty nice uptrending trend line that has not been breached yet. So I will be more cautious if this correction back down could break this uptrending trend line. Then this will be a signal that perhaps more downside will be coming. But in fact, even if it breached this trend line, guess what? We are still at a higher high. A higher high from, a higher low. A higher low from the lowest low, and then still a higher low from the previous low. So then where would I be, will I fully convert my slightly bullish stand to a bearish one? For me, I will be using a Fibonacci retracement again. So as you have known by now, I've been basing analysis a lot on Fibonacci ratios. And right now, let's see this small up wave that we have over here. And let me change so that it is easier for you to see, and zoom in. Yeah. So what the Fibonacci ratios tells us is that on a correction, based on the previous move that it has made, it has a high tendency to be attracted and corrected to the Fibonacci ratios, which is the 38.2, the 50%, and the 61.8 level. So generally, these are strong areas of support which could act as a support, act as a cushion for the correction, and to stop the correction from going further down. So based on this Fibonacci retracement, the strongest level of support would be the 61.8 right here, and this is around $260 level. And we can see, in fact, 260 level previously has been a rather strong resistance for these 4 candles over here. So after breaking through this resistance, it is likely to be a strong support again. Therefore, what I'll be watching for is, firstly, a black crow candle pattern. Secondly, a breach below this trend line, uptrending trend line. And lastly, this corrective wave back down should at least breach this 61.8% level before I would adopt a bearish view again. So you can say that, in fact, even if we breach 61.8, there is still a potential of making a higher low if we compare to this low over here. Yes, but my take would be that the probability is slightly lower now after forming such a huge correction, a strong corrective wave downwards. I would say that the chances of it correcting furthermore would be higher once we see these 3 things happen. So one, and the second one being this trend line, and the third one being this 61.8 level. Okay, and in fact, you do not have to be afraid of missing out on the corrective move or on shorting the market, because we can see that so far have been rather huge, right? So if we measure this correction downwards, it is a 15% move down, in a couple number of days. And after a very small retracement up, and after crashing 30%, it retraces back another 20%, drop down another 7%, and now it is currently up 17%. So if the the going to be real, it is going to be lots of opportunity for you to apply protections to your portfolio at this. If a bear case were to resume in this market, in the case of, let's say, bad earnings, or maybe even highly probable at the 220 level. All right, I've seen comments that it is laggy. Hold on, G connection, I'm afraid. I'll get disconnected. Is it? Lagging? Can you all hear me? Apologize for all the lag. All right, so back to where I was. Yeah, so if situation worsen and get worse, I think a correction, I mean a crash back to the previous low at $220 is very likely. But any further than that, I think it is slightly, I mean, I'll doubt so, because currently we have already reached, I mean, at this level right now, what do we have? The S&P has already crashed 36%. Look, if you focus on my info box over here, it has already crashed 36% from peak to now, from peak to the lowest low. So, and 36%, if you go back to my previous videos on the bear market analysis, it is the average percentage that market crashes during bear markets. Oh my God. All right. Looks like I broke off again. Back to where I was. So yeah, in the previous financial crisis, 2000 and 2007, the worst we have seen was a 50 over percent and 60% correction, or is it 40 over percent, 50 over percent correction? So in fact, given the current 36% crash that we have already experienced, I think that's already quite drastic, quite severe already. And any further crash would signify that what we are going through right now is worse, in fact, as severe as what we have experienced during the dot-com bubble and the global financial crisis, which, in my opinion, is unlikely to be happening and unlikely the case, as we have all known that during the global financial crisis, the economy and the market out there is in fact much more severe. We have major bankruptcies and recessions as well. So
market data connection lost. Connection re-established. Market data connection re-established. Market data connection re-established.
Alright, so sorry for the disconnection again. Okay, so yeah, back to what I was saying. I think that this issue that we have is not going to be as severe as what we have experienced during the global financial crisis and the dot-com bubble. So with that, I think that this 36% is likely the low that we have seen, unless situation really worsen from here on. Okay, so moving on, let's see what we have from the weekly chart. I have not seen this myself for some time already. All right, never mind. Let's switch to trading view instead. Okay, so this is the weekly chart of the SPY. We can see that currently it has already corrected back up above the 150-day simple moving average, which is shown in green. And there's nothing much to be said over here. Just based on the weekly chart, the strong resistance will be somewhere at the $290 to $300 level. Yeah. Okay. And as for the monthly chart, what do we have? All right. I've got a question. If earnings are dropping and debt rising, wouldn't the valuations plummet? Yeah. So that is, in fact, what might happen if really very terrible earnings are going to be announced as we move forward. And but whether or not these bad earnings has been already been priced in to the into the stock market, we do not know. So best is to just react accordingly based on the technical signals and the technical analysis that I've already pointed out previously. So remember the 3 points that we want to look out for before we adopt a bearish view again, and that is the breach below the uptrending trend line, and then a breach below the 61.8 Fibonacci retracement level, right? And on the monthly chart of the SPY, we have a very nice, you can see that this is a very nice bounce off the 50-month moving average. So perhaps really if things were to continue recovering from here on, the worst, like likewise again, could have been already been over and have been everything. The worst could have been priced in already. So we could be already on our way back to recovery. All right. Okay. So yeah, and okay, back on my thing of swim chart, you can see that it is currently at the weekly chart. The candle right now is already at the 100-week moving average support, which could. So what do you mean by tradition pivot point? Just to clarify and make sure that we are on the same page. All right, just would like to clarify with you what do you mean by tradition pivot point? Yeah. Yeah, and as we move into the earnings, these are what we have for the third week of April. And on Monday, we have IBM that is announcing something to maybe look out for. Other than that, most of the company are what I'm not so familiar with. All right, other than Coca-Cola, Netflix. So these are the main big companies to focus on and see how their earnings have been impacted during this period. Texas Instruments, the real damage that have been caused to all these airline companies. And we have some biotech companies like Biogen, Thermo Fisher, AT&T, and Xilinx for some 5G company. And then on Thursday, we have Southwest Airlines, another airline company. So this would be interesting to look out for again. Domino, Intel. Intel. If you have not watched my previous video, it is undervalued company. So something to worth thinking about whether or not you want to take a value investing position in it. And Hershey, something that I would like to invest in, because if you think about it, 20 years down the road, we'll still be consuming chocolates. And yeah, just if I don't recall wrong, if I recall correctly, then I've analyzed Hershey before. It is slightly overvalued if I'm not wrong. Yeah. Yeah. So come to talking about American Express. I have one viewer asked me recently some questions on the credit, some questions on regarding the credit industry analysis video that I've made. So I've reanalyzed the video, not reanalyzed the video, but reanalyzed the company just yesterday. And interestingly, of these four company highlighted in gray, we can see that American Express and PayPal, out of these four credit services industry company, only American Express and PayPal is currently undervalued. So the IV is at 76 and 141, and then their current price is at 80 over dollar and 90 over dollar respectively. So if you look at American Express, it is currently 37% at discount, and for PayPal, it is at a premium of 21%, 22, almost 22% if you compare it to the intrinsic value. All right, so just some things to consider about as we move on forward. And just right now, just like to sidetrack a little bit about myself. So this is my trading portfolio. I'm very glad and just glad and grateful to have been able to stay flat throughout the correction. And currently, right now, my trading portfolio is at 28%. So this peak I've reached this peak previously during the first week of the correction, but then lost some of it as the week progresses, and doing my best to like protect my portfolio along the way. And also during this huge correction, during this huge not correction but crash, during this huge crash, I've been adding long trades, long position, long directional trades along this crash, and then as well as neutral direction trades. So most of my trades are based on options, and these are my positions that I'm holding right now. So you can see that Bank of America I've added back at $23, so that was quite some time back. EM, emerging markets ETF, Facebook, Microsoft, and yeah, and Activision Blizzard. So most of these companies I've already covered them, and they are all fundamentally strong companies. So which is why I am how do I put it? I'm more inclined to trade them because in a sense they are much more stable, and the volatility is not that, I would say, perhaps not that wild as compared to the general broad market of the SPY. Right? So that's for trading. And for my investing, so this is currently the positions that I'm holding, and you can see at the worst time of the market, while the S&P has crashed 36%, my value investing portfolio was down 20 over percent. And right now, while the market is still at a negative, my investing position has already broken, almost close to broken even, with Amazon being the largest winner. So if you're not familiar with Amazon, recently it has a very crazy exponential move upwards. So due to what, I'm not so sure as well, but the news is not so important. What we want to focus on the the technical, is the signals, and the price action. And you can see that during the downtrend, I've been applying protective puts to some of my positions. So some of them have expired and I've applied a new one. So expiring 15 May and 19 June. So this is a put and a EM put. So which means to say that I'm willing to buy EM at $35 if it fall below that price. But with this strong bullish uptrend that we are facing right now, that is likely not the case. All right, so moving on next, I want to give you guys some tips on how to look out for uh, stocks and companies that have relative strength compared to the SPY. All right, so now one thing you can do, you can perform this trick yourself using TradingView. If you're not so familiar, you can go to tradingview.com and then just key in the ticker symbols and just, yeah. So this is just like any other charting software out there. So just let me hide off all this for simplicity's sake. Okay, now let's say you want to invest in some company and you are thinking to yourself whether or not this company is performing better than the S&P 500, than the general broad market out there, or is it a worse company than the broad market. So we take SPY as the average, okay, and we want companies that is performing better than the SPY. So how can we do that? So you can use this compare function over here, and you can add a symbol to compare. So let's say I want to compare, okay, one of my trading positions, Microsoft. My okay, what's my outlook on the local market? Okay, I'll come back to this after I've completed this. So just hang on a minute. So Microsoft. So just click on it, and there you have it. So we want to. So this is the axis for Microsoft. We want to merge all the axes into one onto the right, and then we want to look at percentage change and see this is what we have. And this percentage change is relative to the beginning date. So the beginning date over relative time frame. And for today's example, let's look at year to date. And I'm just going to zoom in, just scroll the mouse button and look at year to date, start of 2020. Now, do you notice this interesting pattern over here? And that is focus on this period. While the SPY is still making lower lows every day, look at what Microsoft is doing. It has already bottomed out higher low. Microsoft is better performing than to Microsoft. This dip in the price. All right, so SPY is at negative 11% year to date. Microsoft has already recovered and is. All right. Sorry for the lag again. All right, so what we want to be looking out for is this pattern right here. So this divergence right here. While the SPY is making a lower low, Microsoft is making a higher low. All right. We want to look out for this divergence. So this divergence signify that the company is stronger and that this mispricing cost to Microsoft has been solved, and Microsoft is already on its way back to recovery much sooner than the SPY. So likewise, you can just key in, continue to add. You can, and let's look at another company. What should we look at? Let's say Apple. All right. If you guys have any things that you want to look at, feel free to type in the comments so that I can just input them into the chart for you guys. So you can see that Apple not so much. We can see that it is following the SPY pretty much. And until recently, it has rise up much stronger than the SPY. All right. Yeah, I see Apple. Great mind things alike. So any other stock? Another one, let's see Amazon. Make things simple. So for Amazon, Amazon has been a rather interesting case. So we can see that it has been lagging the market for quite some time. And then until recently, it surpasses the market. And if we look back at Amazon, is this Amazon? Yes. So you can see that it has been rather beaten down in the past year based due to all they have been faced with. So it is not until they release the superior earnings. Okay, am I back? Right, okay. So let's get back to the question. What's my outlook on the Singapore market, SGX? So personally, for myself, in the Singapore local market, I'm more familiar with the REITs and the banks. So because I do not focus so much on the other companies. So basically, mainly because the market of Singapore is rather small and the growth wrong here. And for investing in the Singapore market, it would be better to go for dividend investing for cash for some like cash flow and income. So I can only comment on REITs and banks. Personally, I think that REITs is going to have some damage to their businesses, especially with all this, with the current circuit breaker that we have implemented and all the stay at home, all this stay at home period. So we can already see that if we just look at some REITs over here, let's say, what should we have? Capital Mall. So you can see that the most of the REITs have already taken a beating and their prices has already dropped very sharply already. So just like this is Capital Mall, and you can see that it has already. Uh, let's go to year to date. Never mind. Let's switch back to how do I close this? Yes. All right. Yeah. So they have already correct corrected very sharply, and I feel that just like the US market, perhaps most of these damage and impact to their businesses could have already been priced in. All right. So what we can do right now is just to look forward and just react based on what we are seeing on the charts. So personally, what I have been doing is to continue just to dollar cost average my way into my positions as a form of investment. So I've already added banks, DBS at $18, 18 over dollars. So as if they continue to drop more, then I'll continue to add more. And if it continue to rise, then I'll just continue to add when they retrace back down to form a higher low. And but simply put, my outlook on the local market is pretty much the same as the US market, because generally Singapore tend to follow the US. So whatever the US is facing, we will be impacted as well. Yeah. Will I be uploading this video? Yes, this video will be uploaded to the channel of at the end of it. I think because of all this lag, I'll have to do some processing for you guys before I upload it again. Yeah. All right. So do you guys have anything for me? Anything to add? Anything to discuss or share? Otherwise, this is for today. Do you think that if the circuit breaker measures extend, the SGX market will fall lower? It's getting a little bit like fortune telling already, right? So it depends really, because I do not know how much has been priced into the market, but it seems like uh, a lot far more worse has been priced in already. So which explains the huge rebound that we are facing back in the past few weeks. While more and more bad news are coming out, we see the market still continue to rise regardless of what is happening. So if these measures extend, I perhaps we might see more impact to the businesses, and then either we can see a sideways market or sideways trending market, or maybe yeah, in worst scenario even back to the crash back down to the previous low is also possible, just like what I've shared in the US outlook. Yeah, and for the local banks, one concern is about the what's this the oil tension. Yes, talking about oil. Yeah, the oil tension and the fall in oil prices. So that's something to be concerned about. But I've just briefly looked into the banks. The exposure to oil is not that much. So there are loans to oil companies and exposure to oil. So I think local banks should be rather safe. And in fact, if you ask me, SG banks compared to US banks, I feel much more safer when I feel much more safer to stick with the Singapore banks, as our regulations and restrictions here are much tighter as compared to the US. So that is one. This is my take on banks, and personally, I feel much more safe when my money is in the SG banks itself. And yes, REITs will definitely be affected the most. So we have already seen a huge correction, and yeah, in fact, when the US was recovering, you can see that the REITs still continued to be suppressed. And while the the US market has already made a higher high, lagging behind the market, is still barely made past the previous high over here. So this is to us, definitely some signs to us that REITs have been largely impacted. So this is Capital Mall. Another one, uh, so this is Maple North Asia Trust, Commercial Trust. So yeah, the portfolio is mainly based in Hong Kong, Japan a few, and some other countries which I can't remember. So this one is performing much better. So this is overseas Hong Kong, mainly Hong Kong, and you can see that China and Hong Kong has been recovering, so is the stock prices. As compared to Capital Mall, which is Singapore based, the recovery is still not as strong. Yeah. So bottom line is really just base your I mainly base my analysis on the technical charts and just react accordingly to what the 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 charts tell me. And one thing about Singapore REITs is that they are uh, highly undervalued right now. So if you believe in REITs, if you believe that the REITs will continue to survive, especially those big REITs like Capital Mall and whatnot, REITs is I mean accumulating REITs right now is definitely a good time. So I mean, in my opinion, it will definitely be a good time to continue accumulating at such low prices. And when when the whole situation recovers and people go back to shopping, uh, which I personally am thinking that when this whole thing is over, huge splurge will be going to be I mean people is going to splurge, so just to like revenge spend what they are and catch up on what they have not been able to do during this period of time. So that would be a boost. So yeah, right now REITs are currently heavily undervalued, and that's my take on REITs. Yes, so back to oil. So I've been looking at oil recently. So this is what we have after all the oil tension has happened. Okay, this is the week. We can see a huge crash back down, crash from 50 over dollar down to like 19, a brief rally up to $30, and then now it is back down to like 20 over dollar. So it has in a sense made a double bottom. So personally for myself, I'm looking to have a short trade, I mean a short-term trade in a long direction uh, from oil. So this is what I have been seeing from the charts previously. Right. Let's see if I can remove this green line. Yeah. Okay, so you can see that previous major crashes for oil, like this one over here, a huge crash made a low, a brief relief rally, made a double bottom, and then followed by a huge rally. All right, so this is one time over here, and of course subsequently, sorry, where was that? Of course, subsequently it continued to crash back down lower. So as a trade, this would have been rather profitable. And there was once I recall seeing a second time. So yeah, so every time there's like a double bottom, this time round also a huge crash, made a bottom, relief rally, made a double bottom, and then a strong rally again. All right. So these are what I've been seeing. So something like this again. So oil, it is definitely very volatile as a commodity, but if the pattern is going to be is if the pattern is going to be repeating itself again, I think currently what we have the opportunity that we have right now for oil is definitely very attractive and appealing. So personally, what I'm looking out for is to catch a relief rally up, but because this is futures, we can see that this is the last day of the I don't know which month's contract is this. If I'm not wrong, it's a May. And then on the June contract, there's a huge jump in price because the different month the contract for the different months for futures, they are priced differently. So in fact, this huge gap up right here messes up with my analysis, and I'm not so I'm not so quite sure of where the direction is going to go anymore for the futures. It could maybe come back down or continue going up from here. And this makes things a bit trickier and harder to trade. But if we look at other other oil related ETFs or index, for example, USO is one of them. So this is much easier as all the gaps have been removed. So if we look at USO, generally it has been on a huge is on a decline, or from the long term perspective. So that's definitely not something that you want to invest in, but it could be a tool for you to trade. And if we look at this, all right, so similar pattern, we can see a dip here, and now it is coming back to make a double bottom. So previously we have a bullish reversal signal, which is the bullish pin bar over here before the reversal. So this time what I'll be looking out for will be a bullish candlestick pattern, and once it forms, perhaps I'll take that as a signal to go long, and maybe back to the 20 EMA, or perhaps even the 40 EMA, depending on how things develop as we move on. Right, so we can see that double bottoms have been rather obvious with the oil with oil, yeah, and I think that this is just one attractive opportunity that appears to me, and I would like to share this with you guys today. All right, so with that, I'll I'll end off here today. Do you guys still have any questions for me? All right, thank you so much for tuning in and staying with me. Appreciate all your support and likes and uh, subscription to the channel. Thank you so much for supporting, and your support has been a huge motivation for me in pushing, in continuing to make videos for you guys and sharing all these educational content for you guys. So with that, I wish you all the best. Stay healthy, and yep, good luck to your trades and investments, and the respective portfolios. Okay, thank you, and see you guys next time. Bye.